Well, welcome. My name is Steve Potts. I'm a serial entrepreneur. Been involved in cancer drug development for the last 25 years, and I am the CEO and co-founder of a stealth company. Raised 47 million to date, and there's an opportunity for a couple additional family offices or investment funds that want to come into our Series A round. Today, we're going to focus on risk and reward, and I think this is a concept that I think about a lot in cancer drug development because I think we all know that there's huge opportunity both for societal impact, for affecting cancer patients' lives, and also for really large returns. But also, it is not without risk. And so, who better to think about and discuss risk versus rewards than a CIO managing a university endowment? So, with me is my friend, Dave Morehead. Hi, Dave.
Oh, happy to be here.
So, Dave, tell us, where are you now? Why are you there? And how'd you get there?
Yeah, so I work at Baylor University. Myself and seven others kind of oversee the endowment here. Endowment, for those who don't know, is just a big pool of money made up of all the donations that people have previously given. Could go to scholarships, could go to programs, could support professor chairs, etc. Basically, it makes school increasingly affordable for students. I think we've done the math, and if the endowment here didn't exist, then every student on campus, not just this year, but next year and every other year, would at least at this point be paying $6,000 a year more than if we weren't around. Um, this is sort of like my second act. My first act, if you will, post college was working in the for-profit asset management industries. Worked at investment banks and hedge funds and asset management firms for the first 18, 20 years. And we have four kids, the eldest of which, when she was in second grade, was asking if she was going to see me in the morning. And the answer was no. But then that kicked off a whole line of thinking of, did I want that to be the case over the next 20 years raising these four kids? So my wife and I kind of thought through what we liked, what we enjoyed. I didn't really want to push the repeat button on anything that I had done previously. I know that that's kind of like what Steve and drug developers do. They keep trying to come up with, the next thing. It doesn't really work that way in my industry. And so we actually moved from the for-profit side to the not-for-profit side. There was an opportunity and fit here at Baylor. My wife had never been to Texas before, so she toured our house 1 hour before we closed. I'm still married, so that went okay. Yeah, so that's what I've been doing here for the last 15 years.
So you just struck me by your comment. You said you didn't want to do something you'd done before. That's kind of and you're investing in entrepreneurs. The challenge with entrepreneurs is they always want to do something for the first time.
Mm-hmm.
And often it's something outside of our comfort zone because if we've done it 10 times, we kind of don't want to do it the 11th time, even though we're really good at it. And I tell my teams in cancer drug development, it's a joke, but it's really kind of true, is that the only thing that works the first time in biology is something you've done before. And so there's this interesting dichotomy between an entrepreneur wanting to do, something entirely new. Cancer drugs deserve a novel approaches, new mechanisms, new approaches people haven't done before. But on the other hand, that carries a lot of risk. So you made a big, step here from what you previously were doing to running a, the endowment at a university. What was the biggest surprise? What would you have told yourself if you're looking back and starting again, where you're doing something new that you hadn't done before, but it appeals probably to a little bit of your entrepreneurial spirit as well?
Yeah, and I would say, yeah, it could be entrepreneurial. It could be the way that I always describe it as a continued interest in learning. So, for example, on the for-profit side, I haven't traded metals or softs, but I have traded about everything else in the marketable universe. So, stocks, bonds, high grade, yield, asset-backed securities, like private deal, like everything under the sun. And so, I guess for me, it was always I feel like I've kind of figured this out. And then my toxic trait, if my kids are talking, is that I get bored easy, right? So if I'm in, an energy focused universe, which I was for 5 or 6 years, and then I feel like I've figured that out, then I don't want to do that anymore, right? It's like less interesting to me. So yeah, coming over on this side of the desk, it's a little bit like your reserve troops. So like when you're direct trading, direct investing is sort of like your frontline troops. And in this role, I'm a little bit more like a general that's sort of like arraying forces and supplying people along the front line because I'm allocating money to the strategies or the markets or the managers that I think are going to make the most money in a certain area for a certain period of time. And that changes over time. So, uh, I haven't changed jobs since I've been here, right? And I'm still at Baylor. I've, you know, previously I think the longest I'd been in any one job was 4 years. And so now I've been here for 15 years. So obviously this is a big enough job that I haven't gotten bored. Then in the last 5 years, I've been in this CIO seat. And the thing that's surprising to me about this seat is how all encompassing it is. So it's not just investing, but it's also HR and it's also marketing and it's also development and it's also, for a while it was teaching. I'm actually teaching 3 classes next month to finance business school freshmen. So I mean, like this job literally does not stop. So that's, in fact, some of the folks on my team have been like, "Yeah, I'm not so sure that I'm interested in that CIO thing. That doesn't seem like a good deal." So that part of it has certainly been surprising to me.
So your team had a huge win, which we'll get into, and I'll embarrass you a little bit because I know you don't love the public exposure. But your team did have a huge win recently. But let's talk about the team first. So in biotech, you can kind of think of cancer companies as either preclinical, you're going into the clinic and you're getting ready for that, and you're really deciding if a drug even has the right, to be in clinical trials. And then you have a clinical trials phase company where it's really about the getting through the clinic and ultimately approval. And for us, and team size is super important. We really like to keep our team small. The joke that I say that, maybe I shouldn't say on a podcast is we try to spend every penny we have on drugs, but it's really true, right? You keep the team small and you keep that team focused on drugs. And in a preclinical setting, it's like a point guard and 5 or 6 basketball players in that team, and the point guard is the chief science officer, and their job is to really get that drug into clinical trials. And then when you have a clinical stage company, it's really about the medical officer, and that team size, again, it's a little larger because there's a lot more logistics in running a clinical trial. I was involved in one with 16 countries previously, 150 sites, so that it can get really big, but it's still, you have to keep the team very small. In that case, kind of the point guard is your chief medical officer. So for you at Baylor, what's the right size team? As you build that team, you've been competing, not really competing, but you're compared against universities with endowments that are much, much larger than yours.
Yeah. One of the benefits that we have, of course, in this industry is that it's very scalable, right? So if the dollars go, Baylor's endowment roughly, rounds to $2.5 billion. If it's $2.5 billion and then it goes to $5 billion, it's not clear that we actually need to change anything, right? So if we were giving a manager $20 million, sensibly, we could give them $40 million and we'd be in the same position that we were previously. Now, as you get beyond sort of like $5 billion to 10, 15, 20, that's sort of like Ivy Leagues, Notre Dame, Stanford, Duke, like those sorts of UNC, those sorts of places, then the team also needs to start to scale because it gets, just like you were saying, in the clinical stage, there's more going on, right? And so I think kind of like, I don't even know if there's a good rule of thumb, but I certainly have talked with folks that, like TCU up the road or Tulane, like the shops that are around us that are approximately the same size. We all have approximately the same number of people, sort of like 7 to 9. And then if you get to $10 billion, tend to have sort of like 10 to 15. And so there's a big gap, obviously, between 2.5 billion and 10 billion. But there is some scaling that has to happen because you're doing more things, right? It's from 2.5 to 5, you can basically be kind of unchanged. But then, if we're giving a manager $20 million, we double in size, then you can give a manager $40 million. It's not clear that you can give that same manager $80 million that you're giving $20 million currently. Like they may not have the capacity to take it. And so that's why I was saying that once you get to 10 billion and beyond, the number of managers that you have has to get bigger to support the size of the investment pool that you're dealing with. So it it is broadly, more scalable, more there's more operational leverage in our business than in a lot of businesses. Is actually like a lot of operational leverage in your business as well, just like there is in entertainment or software or something like that, where you can make one thing and then that thing you can just replicate and it just goes to like a whole bunch of people. So, whether it's Taylor Swift or J.K. Rowling, or it's a pharma drug that, serves 100,000 people or a million people or whatever, like, that molecule is already understood and you can just print more of it. We're along the same lines.
Where do you recruit these managers, and what's the hardest thing for them to learn, early in their careers?
Yeah, so it is a global business, right? Because there's nothing particularly special about money here versus money somewhere else, right? It's still money. So really not just us, but every university endowment, museum, civic foundation, family foundations, et cetera, hospitals, et cetera, we're all looking for talent globally. Obviously, the bigger that you are, so the Notre Dames and MITs and Harvards and Yales, like those folks, obviously they have more resources, like I just mentioned, to spend, you know, traveling the world to go find the best managers in India or China or Japan or Western Europe or wherever. We have less capacity to do that because of our size and the expense of doing such. And so that's one of the things that tends to change as size increases, is that there tends to be more of a truly global focus. So like I know some of those schools have managers in all those countries that I mentioned, and 30 other countries besides. We do have managers globally, but it's a handful. And so that's something that's different, is the resourcing is different.
So kind of back to my biology quote of the only thing that ever works the first time is something you've done before. Are these managers tend to be in the same industries, same geographic focus, same type of investment? Do they move around? And do they get better if you stay and you're only doing metals, or, you're only focused on the India investing or China investing? Do you just get better over time, and do you like to see people just stay there and have 20 years of experience, or do you like to see people move across? What's the risk reward there?
Yeah, so the industry that I'm in, broadly speaking, likes to see people stay in a particular
Mm.
category and, compounding knowledge and capability and whatever in the same place. Because obviously, like if you go from, trading investment grade corporates to trading energy or, crude, natty, whatever, something, anything in the energy kind of, like, those are completely different categories. And so there is some question as to whether or not somebody's capability in one area would translate to another. Interestingly, because of my experience, because I've kind of, bopped around and done some different things, I am I'm slightly predisposed to like the people who have done the same thing, right?
Hmm.
It's worked for me, right? So like I can just look at myself and, well, if somebody used to do real estate and now they're doing global macro, have one of those in the portfolio. What's really involved there is like good thinking. It's not necessarily particular capacity in real estate versus particular capacity in interest rates and FX. Both of those tend to be top down oriented. And so if you get it at the right place at the right time, you tend to do pretty well. I tend to probably be a little bit more interested in the eclectic background of folks than most of the industry is.
Interesting. So let's talk about the team wins. So you recently, been I think a month or so ago, Baylor won CIO of the Year at.
Mhm.
I think of this kind of like the Academy Awards in New York. I wasn't there, but I'm assuming black tie.
Yeah,
So what was that like? I mean, CIO of the Year. I mean, that's how many? That's just U.S. or is that global? I mean, who are you competing with for that
I think
opportunity?
Well, there are different categories, right? And the reason that there are different categories is because how an insurance company invests is different than how a university invests. And that's then different than how a family office invests. And different than a pension, et cetera. So there are different categories, sort of like comparing or grouping, I guess is a better word, professionals together by, based on like what they do. It was, and I made mention of this when I was there, is very different than Central Texas. So, I'm in, I'm halfway between Dallas and Austin. So I'm 100 miles from Dallas and 100 miles from Austin. And obviously this was in, the Mandarin Oriental and on Columbus Circle and in Manhattan. So yeah, nothing like that exists where I'm located. So it was bright lights, and we're not particularly here used to that.
Keep your head down and make money, right?
Exactly. I can drive 5 minutes in any direction and be talking to a cow. So that's kind of where we live.
So, can you talk about some of your investments, the ones you can talk about, and then and along that same line, how do you look for those investments? What kind of patterns do you use as you're making investment decisions? Tell us about a few.
Yeah, so broadly speaking, we're trying to create more dollars for students, the university, professors, programs, et cetera. Basically, we end up being an independent funding source for the university, right? So every year we give 5% of the endowment back to the university, and that goes into the operational budget. Here at Baylor, the endowment distributions is what we call them, is about 10% of the operating budget. In the Northeast, Stanford, Notre Dame, some of the bigger endowments supply 30, 40, 50, 60% even of the operations of the school. So you can kind of think about it from the standpoint of, if those pools of capital were not there to provide funding for the university, then the university would have to come up with those monies somewhere else. The most obvious place is tuition. And so it's, by and large, are a straight offset to what tuition would otherwise be. And so when we're thinking about investing, we have to think about it in that context. For us, I would say for many in the industry, the first thing is trying to truncate the left tail, right? We try to not lose a lot of money.
We
Because
do too.
I mean, like if you just said that to like a student, they'd be like, yeah, I'm all for that, right? Like this is a little bit, this is not exactly how it works, but like if a student's getting $10,000 for a scholarship and the market's down 30%, you don't want the next year to be giving them $7,000 for their scholarship, right? Like that like doesn't really work. And so the amount that we give is actually set up in such a way so that doesn't happen. So even if the market is down 30%, we're still giving the same amount that we gave the prior year, even though we have less, right? So the way to think about that is, if the market were down sort of like 10 years in a row, you could potentially eat through a lot of the endowment, right? Because you were trying to keep it steady. Sort of like the base understanding or expectation for an endowment is that markets are moving up and to the right over time, right? And as long as that's the case, then we can, stomach allocating more capital on a percentage basis in a given year if the markets are down. So the first thing that we're trying to do is reduce big losses, right? Which is interesting that I'm talking to you at the same time I'm talking about like avoiding big losses, because biotech, of course, is known for having a lot of big losses, right? Like a lot of things don't work and go to zero. In that case, in situations like that, we tend to rely very heavily on specialists. So if it's in energy or if it's in biotech right now, based on what's going on, if it's AI, you don't know who the winner or the loser is going to be. Some of these companies that are worth billions of dollars, probably 10 years from now, are worth zero. There are others that we probably haven't heard of that will be worth billions of dollars, et cetera. In volatile markets or sectors or industries like that, we really are relying on managers who have particular knowledge capability in this space. Like, I'm not a virologist. I'm not a biologist. The last time I had biology, I think, was in ninth grade, right? So I have no business kind of like walking through decks and making predictions about like what the next biotech, win is going to be. Like, how would I know that? Right. So we tend to look for managers that have a specific, skill set who do have those, degrees or that experience, and rely on them. Obviously, you get the benefit of diversification, obviously,
Hmm.
and that helps mitigate some of that systemic risk that exists there. I would say in areas like where you operate, there actually aren't that many people who are truly, very, very good at it. So, perhaps there are 50 managers, globally, and you can sort of pick the volatility level, the return level, the exposure level that you're looking for, and kind of whittle things down from that perspective. But yeah, that's kind of how we go about things, not just in biotech land, but in kind of every category. And it's intellectually honest, right? So there are some people that try to do everything in-house, and you're kind of like, that's just intellectually dishonest. So like, it's not possible to have the best people in all categories under the same roof. That's just
Yeah.
not how the world works. And so our job really is to find those categories that we think can be accretive to the university in a manner that's not going to impair the corpus of the endowment, and then go seek those managers out that operate in those realms and put a portfolio of those strategies managers together to try to advance the endowment, not only like beyond inflation rates, but beyond like kind of tuition growth rates. And ultimately, to the extent that we can even do better than that, then, if I can double the endowment in, let's say, 5 years, then the school budget is not going to double in 5 years. So in that scenario, our office then is able to provide maybe 20% of the budget, right? And so basically it's creating an additional 10% of operating income that didn't exist before. And then it's up to somebody else to figure out where that money goes, right? Like I don't know anything about running a school or what the priorities are. That's the realm of the administration and the regents. And so we're a funding engine that helps provide the dollars support necessary to achieve whatever the goals and mission of the organization are.
So you've been an LP in a couple really, fantastic biotech venture funds that are
Mhm.
highly regarded in my industry. How did you get into that? What did you learn from doing that?
Yeah. Can I can I name
Sure.
Essa?
They deserve the recognition.
Yeah, I think we invested initially. I think our initial investment in the biotech space was in 2013 with RA Capital. I think at the time the firm had about $600 million of assets under management. Now I think that same firm, RA Capital, has $8 or $9 billion of assets under management. That would normally be problematic for us, right? It's obviously more difficult to create big returns on higher asset amounts, but it's also the case that the biotech industry at large has grown pretty dramatically over the last dozen years that we've been invested there. So we actually haven't seen any sort of denigration in the returns, and so we continue to be invested with RA. We're also invested in the biotech space with Sands Capital there in DC, Cure Ventures. There might be one or two more that are involved in biotech while also being involved in healthcare services and some other areas. So we do. It's pretty interesting. I think when we were investigating the healthcare space more broadly in sort of 2012, I would say at that point, an allocation to the biotech industry was not necessarily a given for institutional investors. There were some that operated there. There were actually a lot of family offices that operated in that realm because they like the convexity that's available in the industry. But I would say at this point, you know, if an institutional investor does not have 5% or at least a couple of percent allocated to biotech, I would be surprised. Most everyone understands that science continues to move forward regardless of what the markets are doing. Everyone's very well aware of the convexity that exists within the biotech sphere and honestly, the benefit to society.
Yeah, exactly.
We all know people who have either been touched by cancer, disease, et cetera. And we also increasingly know that there are drugs available to, either alleviate or cure those diseases in ways that didn't exist 20 years ago. And so, I think the human propensity to enjoy life and to love those next to you is pretty strong. And so there's, we can argue as the day is long about the cost of this, that, the other. But at the end of the day, if somebody in my family has a disease, I want there to be a drug available to solve that disease. Right. And the amount that I'm willing to pay for that is a really, really high number. And I think that's true for basically everyone. So I think the biotech industry in the US, while not perfect, is clearly the gold standard globally.
It
And
is.
and I think that the increased understanding and interest in the returns afforded by the space is really what has enabled the industry to advance. As more investor dollars come into the space, then there are more things that drug developers like yourself or others can try, or, it goes back to like, ninth, 10th grade, science labs where you're doing experiments and you're trying to see if this works or not. And, a lot of them don't come to be, but some do. And then they help a real lot of people. And if that person, with that disease is in your family, then you're ecstatic. So I think that the combination of kind of like all of those things is why institutional capital has been attracted to the biotech space over the last dozen years.
Yeah, and I remind everyone I honor to testify in Congress on support of the industry. It's just how amazing the biotech industry is and how American dominant it is. This is an industry we should be very proud of. But what I find is just the average person in the American living room just really doesn't understand it very well. And so therefore it is very scary. And so then you get really a lack of funding, a lack of policy that doesn't help us, et cetera. So let's go back to on the risk side of things. We're very aware, obviously, that, and we probably date ourselves, but I think of this like our cancer drugs are like watching them go from preclinical stage of college into the pro stage, NFL stage, like a quarterback into the clinical stage. And it's really hard to predict exactly which one is going to do it. You absolutely have to have the best, your preclinical data package has to be jaw dropping. But it's hard to know if do you have a Peyton Manning or do you have a Ryan Leaf until it gets into the NFL and you say, okay, now perform. And the drugs are kind of like that too. I had a friend that did this for years and has been involved in 3 or 4 successful drugs. And he said, Steve, it's kind of like your kids, you raise them the best you can, and then they just have to go off to college and, in their professional life, and then they have to prove it themselves. And these drugs too kind of have to prove themselves or fail in a clinical trial setting to ultimately earn the right, to be approved and given to patients in a commercial setting. One of the challenges we have is that the large pharmas have figured this out, really about 50 years ago. And so what they do is they have a really big funnel, a big team, and they're always, most of the people there are not trying to advance a candidate, but trying to kill a candidate. So, you might have 50 potential quarterback prospects in college. You're just trying to cull these off to get that one Peyton Manning that might move forward into the pros. At a biotech, it's harder because often you get stuck with 1 or 2, or worst cases 1, and so you're structurally set up to want to advance that candidate, even if they have they're not showing the skills they need, even though the data is not looking like it needs to do in a preclinical setting. So one of the things we're doing, and we're not the only one, is if you get a really good team around you and you focus on something you're really good at. My stealth company is insanely good at small molecule innovation. And so we're applying that in a number of different ways, even beyond small molecules. But if you have a really good team, they can handle multiple candidates at once. And so then you try to recreate a little bit like what the large pharmas have done, which is have the freedom to kill things and say, look, and you almost celebrate it like, good, thank goodness we got that, out of the system when it was in the college stage, and we didn't spend all this money when it gets into the NFL. And so, but you have to kind of create that culture, of like, good job. We we're going to kill this one so we can spend our resources on this one. But if you don't structure it so that you're just either kind of a one company or a one platform, the platforms too can be surprisingly risky because you can think you've got this diversified platform like this, and then you'll have lots of drugs on that platform. But if that platform fails, you also are in a really difficult situation. So I think some of the patterns I see there are the gray-haired people are amazingly helpful at having the
Mhm.
confidence to kill things. And then the other thing we see, is, especially with venture funds, is really the gray-haired investors that can recognize something and say, you know what, guys, you can fire me at this fund, but this company needs to get funded. And they're the ones that really kind of raise their hand and say, this investment has got to get funded. And that's really the only way you kind of get over the curve from a sort of an interested fund to a I'm going to invest in you fund. But for some reason, the people that have more experience, I think, have more confidence to say this one is worth funding and these others are not.
Yeah, and that's interesting. I mean, like we do a similar type thing here, obviously not at the scale or certainly not at the severity that you guys do, right? Because if it doesn't work, then it doesn't work. But we try to in our office, we try to create a culture of being willing to try a lot of new things and we want to fail fast and fail small, right? So just like I said, it was scalable. We can put $1 million behind something. And if it doesn't work out, we figure out that we're not very good at it, then we can stop doing that. Right. And if we find out that it does work and we actually are good at it, then we can like put $5 million behind it or 10. Or we're in the middle of I don't know how to describe it. We're in the middle of an investment cycle right now where we're doing that exact same thing. We kind of scaled it. I think now we have 50 or $60 million behind it. I'm not going to talk about it because we would be
Understand?
impairing ourselves from like a market perspective. And it's actually not me that's leading the charge on that one. But that has been like roundly successful, positive. And so we'll look to continue to scale that going forward until we get to a point where it's not. And so I think in that's probably the closest thing that I can think of that, there's like a little bit of a corollary to what you all do. But we are, because I mean, it's very interesting that we're actually having this conversation because the biotech industry clearly provides societal benefit.
Yeah.
And what we're doing is also seeking to provide societal benefit, right? Like, I don't particularly know who the students at Baylor are going to be 20 years from now or 5 years from now, right? But what we're trying to do is develop a platform, develop a funding mechanism that is good, not just for current students, but for students 5 years from now, 20 years from now, et cetera, et cetera. It's there are striking similarities between sort of like the biotech space and the endowment space, although at first glance you wouldn't expect that
Mm.
to be the case.
Yeah, and there's also a tendency to do what's safer. Again, this risk
Yes.
versus reward. One of our core values is patients deserve our courage. And what I mean by that is the courage to do something where you say the mechanism of action and the investor has to go Google it, like, or use AI and be like, I haven't heard of that one. And you're like, well, good, we're doing our job, right? But that's also scary because immediately you're like, well, has it been de-risked, 8 different ways? It's safer to do, to be like right now there's a real trend in bispecifics and VEGF PD-L1s, and there's 30, 40, 50 companies going at that. And I just think, come on, guys, let take our patients deserve our courage, the courage to do something that other people aren't doing. And they also deserve our courage to kill something and just not waste opportunity cost if this is just not going to be a drug.
Yeah,
You
and
know, I,
that I've kind of learned this from you, being friends and talking back and forth. I kind of learned that about your industry, and I honestly I was actually kind of surprised because I think I kind of like harking back to like high school where you're trying to experiment, see if it works or if it doesn't work. If it doesn't work, then the answer is no, and if it does work, the answer is yes, right? Like you're doing these lab things for like tests and stuff. So I was actually kind of surprised that there's that much of sort of like a me too
yeah,
concept to it. And if it's interesting, but if you track it back, it's basically my industry that's helping cause that, right? Because it's the people who have the money
yeah,
that don't want the money to go to zero, by, trying something new, right? The risk of it going to zero is obviously greater if it's never been done before, right? You made mention of that earlier. And so it's really on the funding side or the investing side where people are, because of their risk return profile, because of their interest in, like what I said, and like truncating the left tail, that then they don't want to fund the new thing. But of course, it's the new thing that could, save your family member. And so I get the tension there. And yeah, it's a tough one, right? Because just like biotech is very competitive, not just within the US, but globally, then asset management returns between, biotech funds or between biotech and then like other asset managers, et cetera, is equally competitive. So yeah, that's a tough one to unlock. I think that basically what you said is true, is that you need to have scientists like yourself who have courage to try the new thing. And you need to have investors like myself who likewise also have courage. Maybe you don't put, an insane amount of money behind something that could go to zero, but maybe we should focus on allocating more capital to those new things that could change the world.
Yeah, and I'm always careful how this gets conveyed, back in the American living room, because there are people that are very anti, our industry that are saying, well, you guys are a bunch of Me Too's, and that is really not true. I looked at the if you look at the just my area, staying in my lane, cancer. Last year, the American approvals, FDA approvals, was about 16 approved cancer drugs. And so you would say, well, if that's true, then maybe most of them are probably Me Too's, right? You actually look at that, and I don't know exact numbers, but 13 out of 16 were actually novel mechanisms. So what's
Mm-hmm.
really interesting is the drugs that make money. So if you're an investor, you're not going to make any money by investing in the college stage. You're gonna make money when a Peyton Manning gets into the pros, and then you have the multi-billion-dollar returns easily or more. The drugs that actually get approved are not Me Too's. Like just that one data set, 2024, 13 out of
Mm-hmm.
16 of those drugs that got over the line, made it to the NFL, the Peyton Mannings, those were 13 out of 16 were novel mechanisms. So I think this is kind of like the film industry, where if you go back and it's one of these things where everyone knew, and then the paradigm gets blown up. So everyone knew there was no money in fantasy films, right? And then all of a sudden Star Wars comes out, so no one's investing, there's nothing going on. Star Wars comes out, and then all of a sudden now everyone knows you should do that. So, how many Me Too's then happen right after Star Wars? But you ask how many of those actually made it into full investment blockbuster hits. Same thing, Indiana Jones, the fantasy genre there, that, they thought he was nuts there too. I mean, a bullwhip and a fedora hat. I mean, come on. It was really out of vogue. He did that. And then I'm sure, the film, the people that are in that industry got flooded with scripts for the, Bullwhip 2.0 and Indiana Jones 2.0. So there is a Me Too tendency in the industry, but what's really interesting is that from an investor standpoint, what an investor cares about is, well, for the approved drugs where you're really going to make your money, these are not Me Too's. And so you have to, I think, just have the courage as an investor to ask yourself, am I in a trend, a fad right now where, Indiana Jones movies are in vogue or Star Wars movies are in vogue, or am I really looking ahead so that when this has a lane to be a true novel, a novel investment?
Yeah, and we see the same thing in investing, right? So like data centers right now are like super hot, right?
Yeah.
Basically what that means is that you could go invest in any data center development right now and you can make like 2 times your money over 5 years. But we were putting our data center platform together 2 years ago, and we're probably going to end up with something in the 7 to 10x range, not 2x. And we're not particularly interested for what we're trying to do, right? And it very well could be different for like a different university. It was a different stage. Like if Baylor had $40 billion, I arguably would not be investing the way that we are today. I'd be more interested in just like maintaining it. But like, you know, the president and the regents here have a lot of plans, goals, aspirations. And so we're trying to do our best to try to fund that. And so to do that, we need higher returns. So I'm not particularly interested in a data center platform that's going to earn 2x over the next, 5, 6 years. And if that is where data centers are priced right now, and it basically is, then we'll just go look elsewhere and we'll go do something else, something that nobody else is doing or thinking about or et cetera. So again, like there's another corollary, right?
How did you? I know when I was losing money in the a couple of one of the down years in my 401k, exactly which year it was, and it sounds like you actually did quite well. Tell us about that. I mean, that was can you talk about the helium investment? That's just fascinating, and how you found that and how you got into that.
Yeah, so there's all sorts of different things. I benefit simply from having traded a lot of things in the past. There are others that are in my seat and other institutions that have like similar backgrounds. So probably one of the most not obvious, but one of the clearest examples would be in pre-pandemic in 2017. There was the financial crisis in 08, 09, and then, the economy came out of that scenario. And then from 2010 up until 2020, the market just kind of like went up and to the right basically every day. And so by the time you got to 2017, 2018, the volatility in the equity market had actually shrunk to historic levels, right? So volatility in finance speak is simply a standard deviation of price action. So it can't go to zero. Like if it was zero, then it would mean that all stock prices stayed the same forever and never changed, right? So unlike negative interest rates, volatility of zero cannot happen, which is the math concept. And volatility at that point was single digits, like, 7, 6, 7. Volatility right now is kind of in the 16 to 18 to 20 percent range as opposed to 7%, right? So at the time we decided that volatility was the cheapest thing on the board, right? So it was the cheapest thing that we could invest in, and so we did. Most endowments are value oriented at their core. I think that comes a little bit out of academia, but it's also a bias to like not want to lose money to the downside. And so we owned a bunch of volatility. And when the pandemic happened, obviously the market was down 35%. I think vol went to 80. Right. So it went from like 7 or 8 to 80. We weren't there for the whole thing, but that hedged a large part of our book, that we were then able to sell. I think we were up 65% or something like that. And we were able to sell that and then buy equities that were down 30%, right? So as with any institutional investor, we have more options. We have more availability for things to like, take off the shelf and invest in than retail investors typically do. And so, but that's our business, right? Like that's our job.
How are you different than the family offices? Like, what's their strengths, and how is it different? How should I think of that?
Yeah, so I mean, there are some differences that actually I think fall strongly in the favor of family offices. Most family offices are not set up like foundations, and so we're a 501(c)(3). We're basically required by law to give somewhere between 4 and 6% of the endowment back to the school every year. That does not exist for a family office. So we have particular liquidity concerns and issues that family offices often don't have. Similarly, family office, to the extent that the family itself is willing to take more risk, they can, right? It's their money. We are governed by state and federal law in terms of how diversified we have to be. Everything is judged by, would a prudent person invest in this? And so like if I put half of the endowment in Tesla, I'd probably end up in jail, right? That doesn't exist in family office land, right? If the family is willing to back it and assume the risk and swing for the fences, they can. It's their money. And a lot of those laws are put into place because ultimately this is a social good, right? Like if you're managing money for a hospital or a civic foundation or a university or even a family foundation, like that's all assumed to be societal good. And so there are laws around that to sort of protect society, if you will, from the unintelligent or overly aggressive CIO or administration that's seeing that and, doesn't care about future generations and just wants to spend it all down to zero today. Families, of course, if they have, we see a lot of this in Texas, if they have like a big oil company and then they sell it to one of the oil majors and they end up with, 5 to $25 billion, and then they need kind of professional staff to manage that. The professional staff look a lot like our office, but the difference is that that money doesn't have any strictures on it
Yeah.
because it's the family's money, right? So it actually enables family offices to potentially be more risk seeking. Like we would say that some of these groups like endowments tend to be more risk averse, right?
Hmm.
That family offices, depending on, kind of the governing family, they could be accepting of more risk, of more money going into biotech, for example, something that has the convexity, then they understand that. More money going into energy, for example, right? Like particularly if it came from that, they're familiar with the volatility associated with that space and they're okay with it, right? They made a bunch of money doing that. And so there are a lot of ways that family often are the earliest groups in some of the newest, more volatile sectors of the institutional space for that reason.
Hmm, interesting. Speaking of family offices, Jerry Stead, who has been a wonderful leader in the corporate world and has a family office here in Arizona as well as elsewhere, he's got a great quote that really just sunk in to me, which is the entrepreneurs that need to have an intense, I think I'm exact word, intense, insane focus and curious focus on the customer. And for me, and I think it's a good way to end this podcast is really thinking about the customer. For me, it's a cancer patient. And for us, we're focused on big areas of cancer where there's big unmet need, pancreatic, lung, colon, breast. And there is not, we're not happy with the current standard of care. There's a need for real breakthroughs there. So that's my focus. And we work backwards really into, I think, what mechanisms and things we want to go after. But it does start there. I assume for you, the customer here is really students, right?
Mm-hmm.
And so, I think back to how, I've known you for 30 years. For those of you listening, Dave and I were freshmen and sophomores together at Wheaton College in Chicago. You were a couple doors down from me, and we've gotten together every year, since then for what we call Cinco de Mayo. It's just, again, another really value of college is, building these lifelong friendships. But I think I majored in physics and pranks, while you majored in finance. And I didn't know this about you actually, but you were a janitor,
Mm-hmm.
basically making your way through college, which is probably why you were the target of pranks, because you were gone while we were sitting around thinking about
Exactly.
pranks to
Exactly.
do
Yeah.
to you.
Some so from 3 to 5 to 6 every day, like I took all of my classes between, 8 a.m. and 2 p.m. because from 3 to 5, 3 to 6, I was at the local junior high down the street, cleaning up after junior high kids for a couple hours every day. And I did that, all 4 years through college. So, help pay the bills.
So, I mean, first of all, what does that tell you about character? I think, and then probably that those kinds of experiences have probably been helpful. I mean, frankly, the CEO job is a janitor 90% of the time.
Mhm.
You're always figuring out, things that can go wrong and how to keep them from going wrong. But I actually, now that I know you were doing that, I feel a little guilty about some of the pranks we did. But on the other hand, it just for the audience, it's pretty funny. And since Halloween is right around the corner, we reconnected. Our daughters both went to school at the same, they're freshmen, same class, a similar kind of college, liberal arts, Christian college, Westmont, on the West Coast. And you were kind of guiltily made a confession. You said, remember that smell you had up in your closet? That was actually a pumpkin that my roommate and I stuck up there. And I do remember the smell. I'd forgotten what it was. I was thinking it might have been a fish, but you did own that. But going back to that is your customer, right? And
Mhm.
and I think even it was amazing seeing you win that award, but you really aren't competing like we
Mhm.
are directly with a number of other cancer
No,
companies,
yeah, I
similar
say this.
ideas. It's kind of a rising tide lifts all boats, right? In this university investment thing area.
Yeah, I say this all the time, right? Like I wouldn't have gone to school if I didn't have scholarships to help me, make it through school. And so I am employed by Baylor, and so we're working and make every effort we can to push the endowment at Baylor University forward. But like as it relates to the industry, like I said, this is like a social good, right? There are students that are going to go to Kansas State or Notre Dame or Georgia or whatever. Like I know the CIOs at those places and they have the same interests that I do. And we share ideas.
Hmm.
I mean, there are some in the industry that don't. I think that that's a little short-sighted and self-serving because there are some CIOs in the space that are comp versus, what their school down the road is doing. And so that compensation metric is silliness from my perspective because like every university needs, their own set of objectives. And it's like what Dartmouth needs is different than what Yale needs. What Baylor needs is different than what TCU needs. So even though you play each other on the football field, like what you need on the funding side is different and distinct. And it's kind of it's kind of short-sighted to be, comping versus the person like the what I'm doing trying to create dollars is not an athletic pursuit. And
Mhm.
so we're very open. Baylor is. It's usual for me to say that this asset management is not the CIA, right? We don't have state secrets.
I love that.
If we tell other people what we're doing and it could help a Kansas State student go to school that otherwise might not be able to go to school, like God bless, like that's fantastic. And so we're pretty open about sharing what we're doing and happy to talk to folks. So there's a more of a camaraderie, I think, in our universe than obviously exists in what you're doing because other people would lie, cheat, and steal to take your molecule and go do it themselves. That doesn't exist as much in our space. Honestly, we don't have anything that's that unique. Yeah, we share manager names, we share investments that we're involved with. I could go, pick a manager off the board, and there's probably, a handful of other endowments that are invested in the same manager at least. So it's pretty easy to kind of suss out, where the talent lies, and everyone tends to gravitate there.
So, just final question: what would you tell your freshman self besides lock the door at night? What would you tell your freshman self looking back on the career you've had?
Yeah, I think the way that you answer that is basically what was the thing that when you look back you didn't do a good job at, right? And then what have you learned since and would have helped course correct earlier? And I would say to be less scared, be
Hmm.
less scared of failing, be less scared of what other people think, to try new things, that it's okay to try something and have it not work out. I think, I'm first kid, a lot of first, children
A lot of,
kind of like
lot of
want to do
pressure.
everything perfectly. You don't need to take a chance. It's not, at least in this country, like your hand doesn't get, chopped off if you reach for something and you try to do something. So I would say that a lot of my early life and even early professional life was probably governed by fear of failure and not truly attacking an opportunity or not trying the new thing. And so that's something that, my wife and I, we try to course correct with our kids. What remains to be seen if we're successful. But yeah, you tend to learn what you didn't do exactly right and hope that your kids will do better.
That's fantastic. Well, Dave, thanks again. Happy Halloween to those listening, and apparently watch out for rotting pumpkins in closets.
Exactly. Happy to be on this with you. Thank you.
Take care.